evening, and welcome to Bajaj Finance Limited Q2 FY26 earnings conference call co-hosted by JP Morgan. This event is not for members of the press. If you are a member of the press, please disconnect and reach out separately. Please note that this call and your questions will be recorded, and the recording will be made publicly available. By participating in this event, you consent to such recording, distribution, and publication. All participant lines are in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. I'll now hand the conference over to Mr. Anuj Singla from JP Morgan. Thank you, and over to you, sir.
Thank you, Nirav. Good evening, everyone. This is Anuj Singla from JP Morgan. Thank you very much for joining us for the Bajaj Finance Q2 FY26 earnings call. To discuss the earnings, I'm pleased to welcome Mr. Rajiv Jain, Vice Chairman and Managing Director, Mr. Sandeep Jain, COO and CFO, and other senior members of the management team. On behalf of JP Morgan, I would like to thank Bajaj Finance Management for giving us the opportunity to host them. I now invite Mr. Rajiv Jain for his opening remarks, post which we will open the floor for Q&A. With that, over to you, Rajiv, sir.
All of you. The investor deck for Q2 FY26 has already been uploaded on our website. I hope you had a chance to go through the same. I'll quickly focus on key updates for the quarter before we move to Q&A. Overall, good quarter across key metrics of AUM growth, OPEX to NTI, and profitability. ROA and ROE remained steady. Q2 credit cost was elevated. We expect full year credit cost to be at the upper end of guided range of 1.85 to 1.95 now. In terms of growth drivers, if I move to panel number 47 actually. So I'll keep moving panels, so be with me. Assets under management grew 24% to 4,62,261 crores, led by secular growth across businesses. New lines of businesses, namely gold loans, new car loans, CV, tractor, are growing in a healthy manner and contributed to 3% of overall AUM growth in Q2. MSME growth, which we have flagged in last quarter, moderated to 18% as part of our risk-first approach to ensure portfolio resilience and long-term sustainability. The captive two-wheeler and three-wheeler finance business is getting phased out as per the plan, strengthening overall asset quality trends from FY27 onwards perspective. It now only contributes to 1.5% of overall AUM. Customer franchise, a key driver of growth momentum for future years, expanded to cross 110 million to end at 110.64 million. We added 4.13 million new customers in Q2 alone. We now expect to add 16 to 17 million new customers in FY26. In general, from a growth standpoint, if I look at the outlook, the company has decided to take a prudent and balanced stance on AUM growth for FY26. And we now think the growth will be in the region of 22 to 23% as compared to our earlier assessment of 24-25% due to a set of risk actions that we have taken in MSME business and the revised assessment provided by BHFL on its AUM growth for FY26. So we now would circle up our guidance to 22 to 23% growth for full year versus 24-25% that we had penciled in January 26 January 25 when we talked about. In terms of cost of funds and liquidity, cost of funds continue to improve by 27 basis points in Q2 and came in at 7.52%. For FY26, we expect cost of funds to be in the region of overall full year to be between 7.5 to 7.55%. NIM came in flat in line with Q1. Deposit book, which contributed to 18% of the overall consolidated borrowing, grew by 5% year on year. For FY26, in general, as we saw in the trends in Q1 as well, the company has adopted a measured stance on its deposit program with higher focus on delivering cost of funds efficiencies to the businesses. And we'll share greater detail on deposits business as part of LRS that we'll publish for FY26. In terms of operating efficiencies, company continued to deliver efficiencies. OPEX to NTI improved to 32.6 as against 33.2 in Q2 last year. AI implementation across each line of business continues to move forward and should start to reflect in costs and productivity benefits over the next 12 to 18 months. In general, we remain very, very excited about the FinAI transformation. On risk and credit quality, loan loss to average AUF came in at 2.05% compared to 2.02% in Q1 from a sequential standpoint. Credit costs principally remained elevated in Q2. However, the good news is that the vintage metrics, when we look at the portfolio across 3 MOB, 6 MOB, 9 MOB, are showing significant improvement. As a result, we expect full year credit costs to come within 1.85 to 1.95% for FY26, and we expect significant improvements in credit costs for FY27. On credit costs, let me just give you a double click on it to give you some texture. So MSME business remains under watch, and companies taken significant risk actions. We have virtually cut MSME business by 25% in our unsecured MSME volumes. We now expect MSME business to grow in the current full fiscal by 10 to 12% only. The captive 2 and 3 wheeler business continues to, which contributes to 1.5% of AUM, but accounts for 9% of the overall loan loss, also continues to run down. That should also lead to significant improvement in loan loss to average AUM metric in second half of the year and also in FY27. GNPA and NPA came in at 124 basis points and 60 basis points. In general, let me just flag that on a first quarter to second quarter, the number goes up or moves up sequentially because of high number of days between Q1 and Q2. So you will see that even in last year as well. So the number moves anywhere between 15 to 18 basis points, 18 to 20 basis points, as Sandeep is correcting me, which is really how it is for the last 2 to 3 years if you look at the trends. On portfolio credit quality, the management assessment for rural B2C and MFI has been improved from yellow to green, as you can see it in the numbers itself in the portfolio quality panel. Lastly, but most importantly, I would like to just re-emphasize the point, you're aware of it as long-term investors, that we principally remain a risk-first company. Let me now switch over to FinAI transformation. Soon we'll start to publish metrics as well. We are 8th, 9th month into implementation of FinAI transformation for us as a firm. Remains central to our long-term vision, and we are on track to become a future-ready AI financial services company over the next, I would say, 15 to 18 months. It's underway across each line of our business and should start to reflect in cost and productivity benefits and for consumers as they experience Bajaj Finance over the next 12 to 18 months. We as senior management are now spending virtually over the last 8-9 months 12 to 15% of our time on FinAI transformation. We have identified as a firm, as part of our BPR process, 123 impact areas, high impact areas across business and functions, with 80 of them which will plan to go live by end of Feb 26. So lots of action happening on FinAI. Some of the capabilities are already live, like B2B businesses. I'll give you some texture. 442 AI voice bots are now live. They contributed 2,000 crores of origination in Q2 alone. It's 5 AI conversational bots, text bots are live for EMI card, extended warranty, personal loans, health insurance, and life insurance. The conversion rates in general are quite encouraging. We foresee that all our communication by March 26 would have a bot in it, depending on the affinity product that we principally see. So far 5 have gone live. The pace will now increase very rapidly as we get into second half of the year. 85% of customer service resolutions in Q2 was resolved via AI-powered service bots. In B2B, where we move a lot of volume in these 40 days, 42% of loan applications in terms of quality checks was performed by AI. We booked in the process 6.5 lakh loan applications in a single day with zero compromise on operational and compliance risk. So we've continued to perfect. This number is at 42. Eventually has to go to 85-90%. So good work done, but there's lots of work to be done as we move forward. In terms of content generation, 42% of our digital banners, if you go to our asset, and 100% of videos, if you experience, are now principally AI generated. We're also using AI for significant enhancement or enrichment of data variables in terms of using audio recordings to extract meaningful variables, and we are quite excited about the kind of data breadth and depth that it would really improve as we deploy this capability across our voice ecosystem. We're also one of the areas that we are very excited about on FinAI is deploying face recognition technology. We're going to test with 300 points of sales, service, and gold loan branches to identify existing customer and create a wow experience when they walk into these branches or points of sale. That's something that will go live between now and December and should help significantly transform the experience. So that's really on FinAI. I've so far covered consolidated financials and company. I've talked about FinAI. Let me now jump over to subsidiaries. BHFL has already published its results. They had a stable quarter with AUM growth of 24%, despite heightened competitive intensity, I would say, and significantly higher than expected portfolio attrition. They still delivered a PAT growth of 18% and ROA of 2.3%. Asset quality for BHFL remained very healthy at 26 basis point GNPA and an NNPA of 12 basis points. BFSL, which is the other subsidiary, albeit smaller, saw 40% growth in AUM and profits were up by 27%. It added 94,000 customers in Q2. Very quickly, just before I open up the floor for Q&A, I thought I'll just provide two more updates. One update is on management. As if we made a set of announcements in Q4/FY25 regarding the management structure. The board of directors at its meeting held today has approved the elevation of Mr. Manish Jain as the fourth deputy CEO of the company. Manish, in addition to his current role as managing director of BFSL, will also now be responsible for company's loans against security business, commercial lending business, and the deposits business. So the company would now have 4 deputy CEOs and 3 chief operating officers as what we call executive management group running the firm. Just before I finish, I thought I'll just give you a quick update on the festive performance. Clearly, the structural reforms in income tax and GST by the government has lifted customer sentiment and spurred consumption. Led to a very strong season. We've already done a press release where the company disbursed a record 6.3 million loans, up 27% in volume and 29% in value over last year. This is a 37-day, right, Manish? 35 days. 35-day period. It's Navratri to Bhai Dooj, or 35-day peak kickoff of the festival and end of the festival season. Overall festive period disbursements were 7.4 million loans we did, and a 26% increase year on year. And added 2.3 million new customers during this period, with 52% new to credit, at par with previous years. So that's really end of my opening remarks. We are pretty confident of delivering sustainable growth, managing risk proactively, and leveraging technology and AI to create long-term shareholder and stakeholder value for everybody. And happy to take questions now. Anuj, over to you.
Very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, Rajiv. So firstly, with respect to growth, you indicated mortgages and SME growing slightly slower, but again, at the same point in time, festive appears to be quite strong, and everyone seems to be quite constructive on the growth. So are there any other segments which you would be worried about in terms of like pulling back on the growth side? Because new businesses are also scaling up well, or it is only on account of these two product segments that we are revising the guidance lower?
Both these contribute to 31% and 14%, 45% of the balance sheet, right?
Yeah.
Contribute to 45% of the balance sheet. And so in a way, your point is absolutely right that the other businesses are picking up the slack. We are just, the guidance reduction to contribution of these businesses and their slower growth is meaningfully being made up by other lines of businesses, Kunal, as you can reflect on. So we remain quite excited. It's other businesses, whether it's gold loans, car loans, rest of the business, LAP business is growing quite healthily.
Okay. And in fact, now rural B2C would also start, given that now it's starting into green, so that will also contribute to the overall growth.
That's correct.
Okay. And secondly, with respect to asset quality, so stage 3, it's moving up. Would it be fair to assume that larger part of this flow is from stage 2? Maybe net number is quite small, but including that, otherwise when we look at it, like maybe the GS3 increase is all across the segments. When you look at it, all the product segments have seen a significant increase. So that's largely the flow, only the flow through which is there.
Yeah, and Kunal, your assessment is absolutely right.
Look at them together. Yeah. I'll hand it over to Sandeep.
Yeah. So I think if you look at even last year, Q2, you would see that the GNPA sequentially goes up. This is peculiar. There's a peculiar situation that you have 231 days month in Q2. And since we have recognition of stage 3 and GNPA on number of days, the customers who are at the edge, which is 88, 89 days overdue, goes and crosses 90 days position on in the September quarter. So as a result, versus a normal quarter where you see 3 months of GNPA flowing in, etc., you see in Q2 1 additional month of GNPA. That creates like 18 to 20 basis point of additional GNPA formation in the quarter. Now, having said so, on a YY basis also the number is higher.
And correspondingly, correspondingly there is a benefit that appears because of fewer number of days in fourth quarter.
Correct.
So, just to level the point.
Correct. Having said so, the number has gone up between, say, last year same time to now. Last year same time was 1.06% of GNPA. Currently it's at 1.24%. Out of this 18 basis point, the captive two-wheeler financing business, which is on rundown mode, contributes to about 12 basis point of additional GNPA formation. And the MSME, which is what we called out in Q1 as well, has contribution of another 6 basis point. So these are the two businesses to call out. Other than that, all other businesses have held their performance on a YOY basis and sequential quarter basis as well.
So sequential is purely number of days, Kunal.
Yeah.
And year on year is principally on account of two-wheeler and MSME.
And the last point on that is to the point that I'm making on stage 2 to stage 3. The overall formation of stage 2 and stage 3 put together was just about 162 crores for the quarter. One of the lowest that we have seen in very, very long time.
Got it. Okay. Yeah. Thanks and all the rest. Yeah.
Thank you. Next question is from the line of Jay from Nirmal Bang. Please go ahead.
Hello, sir. Thank you for the opportunity. So my first question would be...
Jay, sorry to interrupt you. Can you please speak through the handset?
Yes, sir. Am I audible, sir, now?
Better. Much better.
Yeah.
Thanks.
Yeah. Yeah. Thank you for the opportunity, sir. So my first question would be on the MFI lending. So we see there is a 217% growth year on year on that book. So do we expect that the pain in the industry has peaked out or it is plateauing? So some comments on that. And my second question is on tractor financing. So can you give the split between used and new for the same?
So We are too small in MFI. Balance sheet is only 70 and 50 odd crores. So, the right people to comment on whether the worst is over for MFI or not. I think that's first point. We are focused on our portfolio. As you can see, at this juncture, the portfolio, based on the disclosure we provided, is at 99.22% current. So we continue to tread carefully, knowing fully well as to what's happening in the industry. Tractor, again, the book is very, very small. That's point one. Total book is 1,000 crores, so not material. But on a more important basis, we have, as we started the business, we were very clear as to what the mix is to be. The mix is to be 75 new and 25 used. That's the mix, and that's a mix with which we are building out the business. So our portfolio modeling says that for us to deliver minimum hurdle rate of return on equity in the tractor finance business, we'll need a 75-25 mix, and that's really what we are going with.
Okay, understood. And sir, do we have a partnership with the OEMs, or it is like how does the partnership with the OEM work here? Like
in a typical B2B business, this is a B2B business. We work closely. They're mostly very regionally dominated players. We work with all of them. I mean, we are not pan-India as yet. We are in 400 towns. We are in 400 towns in India at this point in time. And predominantly south and west, north and west, dominated. So we're just building it out. It's too small as yet.
Okay. And sir, last question on MSME lending. Sir, we see GNPA growing up significantly. Is it because of the regional rainfall issues which were highlighted by the peers?
As we had outlined, we're seeing in last first quarter we talked about it, that we are seeing incipient stress. It's across the board. It's not regional in nature. And as I've said in my opening remarks, we've cut business by 25% and hoping that the worst is behind us by between March and June, and it can be in a growth mode from there on.
Okay, sir. Thank you. Thanks a lot. That's it from my side. Best of luck.
Thank you very much. A request to all the participants. Please restrict to one question per participant and rejoin the queue for a follow-up question. Next question is from the line of Sukrit Patil from Eyesight Fintrade. Please go ahead.
Good afternoon, team. I have two questions. The first is it's a forward-looking question. As more fintechs and NBFCs scale up across India, what is Bajaj Finance doing to build a strong edge, not just through AUM or app downloads, but something more deeper, like a way of working or thinking that grows over the time and makes your competitors hard to copy your model? Thank you.
I mean, we could spend 1 hour on this question, quite honestly. But on a more serious note, we, for the last 3 years, have published a long-range planning document, demonstrates how we're thinking about the company, the business, the diversity of its businesses, the way we see franchise growing, size growing, our ambition. So I would request you to look at that document, which provides reasonable coverage. And if you see it rather than on 1 year basis, if you see the pattern over 3 years since we started to publish long range plan, you will connect the dots much better. We are anyway headed into our fourth release of long range plan, which will be published on 5th of December this year, because we have an investor day. So we would welcome you to come and join us for the BFS Investor Day, where I'll be sharing what a long range plan is. But we remain quite excited, is what I would say. We're building business. Last point I would make, we're building businesses with a 10 to 15 year view. We are very clear we have to deliver the short term, medium term, and the long term, all three at the same point in time. I think that's the principal differentiation, if you ask me. Sustainably for the past, present, and I would hope for the future as well.
Thank you. My final question, again a forward-looking one, is about margins and cost planning. As growth picks up and costs go up, whether it is tech, compliance, or collections, or any other things, how do you manage to keep the profits line profits in line without cutting any corners? Are there any smart ways you have built into your systems, or you will be implementing, that will help you stay efficient even when things are getting costlier?
No, so at a fundamental level, process automation, technology leadership, as a technology leadership at an underlying level, followed by process automation, followed by now FinAI, will allow us to continue to generate velocity on one hand, benefit from scale on the other, and ensure costs keep going down. All three will happen. And that's why we are a big believer in technology. It's early adoption on one hand, and do it we are quite excited about it. We've remained excited about. We started to use cloud way back in 2007. We used data very extensively between 14 and 20. We built a 75 million app franchise. We do think it's now very close to being Amazon of financial services in India in terms of experience, and we think we want to pioneer AI and financial services in this part of the world. So all that for what? For scale, velocity, controllership, and eventually lower OPEX to NIM. So we see technology as playing a multifaceted role across the value chain.
Thank you for the guidance, and I wish the entire team best of luck for Q3.
Thank you.
Thank you very much. A request to all the participants, kindly restrict to one question per participant and rejoin the queue so the management can address all the questions from all the participants. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for taking my question. Just two questions that I had. Firstly, in addition to what we've already shared on the MSME segment, if you can give some more color. All I'm trying to understand is, I remember in the first quarter earnings call we had shared that we spoke about another 150 crores of loan restructuring in the second quarter. I think this quarter we have done about 288 crores. So, was the asset quality experience in MSME much more pronounced than what we were earlier expecting? And then I also heard Rajesh sir earlier say on the call that maybe by March and June next year is where we are expecting this incipient stress to settle down and be back in the MSME. So, how much restructuring are we expecting in the MSME business in the coming quarters? And like I asked, if you can give some more color.
We're mostly done with restructuring, Abhijit. We're mostly done with restructuring. It is used as a tool to enable good customers to assist them. So in terms of restructuring that you will see over the next few quarters, our number will be very, very low. And that's just one point I want to make. Sandeep wants to add.
Yeah. The other point that I want to make, I think it's in the interest of all the participants on the call. I think we don't want the discussion to get hijacked by MSME discussion the way it happened last quarter. Just to reiterate the point, we are on top of it. We have taken corrective actions. We believe that the problem is manageable. We've also provided guidance in terms of growth, credit costs, and so on and so forth. Nothing is alarming as such. So I would request that we focus on other areas, important areas, than just focusing on MSME as a segment.
And actions have been outlined to all investors. As Sandeep said, it's not changing the overall credit cost guidance in any given manner. And that's the power of a diversified business, that there are pluses and there are minuses. Net, as building a sustainable business for long term, it helps us and it helps investors in the process.
Got it. And then the only other question I had was, maybe 15 days that the festive season has got over in India, while we have already given out a festive season update. If you could give some color on whether this momentum is sustaining, or do you think that we're now kind of...
Yeah, momentum, Abhijit, is yes. I think we're surprised by given that the festive season was strong, but I would say in general the consumption patterns look quite promising, is what I would say. based on our understanding of the products that we finance.
Got it. And sir, would you also agree that this momentum has sustained across most of the product segments that we are present, including consumer durable, auto finance?
Yes.
Answer is yes. Got it. This is useful. Thank you, sir.
Except I would just add. Abhijit, just to be fair, I would just add we are very dominant in electronics, so what we say is happening to the market. We can say that confidently. I'm not so sure I can say that for auto being new cars and so on and so forth. We are growing on a small base, so I can say it's strong for us, but our base is smaller. So I just want to flag that point. In electronics or any of the consumption loans, we are pretty dominant. So we can say that what's happening with us or what we are driving does lead to denominator expansion.
Got it. This is useful. Thank you so much.
Thank you.
Thank you. A request to all the participants, kindly restrict to one question per participant. Next question is from line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi team. Congrats on the quarter. Just specifically on B2C, we are.
Piran, sorry to interrupt you, but we are losing your audio.
You dropped.
Okay, is this better now?
Better now, yes.
Yeah. No, so just wanted to get some sense on how things stand in rural unsecured, rural B2C in terms of, you used to give this data on how many customers are 3PL and above and how that has, has been higher than history. Is the fundamentals also improving? Just in terms of over leverage.
The answer is, and principally that was, Piran, is a fair question. Across businesses that we are in, we've cut 3PL to prior to 1920. It has meant, I would say, reasonable growth dilution, but it is one single univariate variable that's helping improve portfolio performance, I would say. So let's say if you take rural B2C, numbers below 1%, less than 1% is what somebody with 2PL would be. In urban it would be 4%, 3%, 4.8%. So we have cut business. This numbers used to be 13 and a year ago 13% and 3%. So I can go business by business, but as we concluded that it's a important demonstrable variable, metric of prudence, we've gone hammer and tongs after it, and it's showing benefits.
Okay, and this is on incremental or it is on your book?
Since February, whatever you are originating is on these numbers. So it's incremental, but the book churns. You know that, right? So our behavioralized maturity of the book is 20 to 23 months. So to that extent, the book churns pretty rapidly. What we track is not just we track vintage performance. What we are heartened by is the 3 months on books, 6 months on books, and 9 months on books. So if you take February onwards, as I said, we started to take very drastic actions across portfolios. We were taking even earlier, but it was much more drastic from February. We're seeing 3 MOB, 6 MOB, 9 MOB now. Virtually 9 MOB is coming. Improve significantly. So it's just a matter of time that the whole portfolio churns.
And talking about rural B2C, after a long time, we have now revised the management assessment from yellow, that it was tagged for close to about 2 years, to green. We are reasonably confident with the kind of change management that we have done in the business, the granularity with which we are building the rural B2C business, and the significant improvement that we have seen in the vintage performance in the last couple of quarters. We are quite excited to rebuild the business and grow it faster.
Got it. And just secondly, you had mentioned captive two-wheelers, which is 1.5% of the book, is 9% of loan losses. So it's 9% of this 2,200 crore credit cost number. And so the non-captive would be how much? Just want to get a sense of what's the difference.
It's equal size virtually. As you can see on panel 47.
No, I mean in credit costs.
That if you see the number at, if you go to, we've separated it in the portfolio quality. That book, of course, is growing a lot more faster. Just go to portfolio quality. I think 98% current. Is it 97? Yeah. Just give me one sec. That's 97.8% current. We are very clear. It has to be at lower than, it has to be at 1/3 the loss of our captive business. We are very clear. That's the choice you made.
Okay. That puts some context. Fair enough.
Yeah, okay, and to the question that you're asking on open market two-wheeler financing, well, the vintage will have to still play out. Based on the number available so far, 1.5% to 2% balance sheet contribution, and same is the contribution for loan losses. Eventually, it will probably be, let's say, 1.5 times of the portfolio contribution, because the business generally operates at higher credit cost compared to what we deliver at the organization level, but will be significantly better compared to what we are observing at this point in captive two-wheeler financing business.
Understood. Okay, this answers my question. I'll get back in the queue and wish you all the best.
Thank you, Piran.
Thank you. Next question is from line of Ashish Sharma from Oaklane Capital Management. Please go ahead.
Yeah, I hope I'm audible, sir.
Yes, you are.
Yeah. Just one question on credit cost. So has he given the guidance for FY27? So given that now we'll be closer to the upper end of the guidance at 1.95, but you seem to be confident about the credit cost outlook for FY27. Have you given a number for that? Or what would be the normalized credit costs?
So we are not giving absolute guidance at this point in time, Ashish, but very clearly, the direction of the travel suggests that we should see a much lower credit cost in FY27. If the trajectory that we are seeing today should continue for the next year, we should definitely see a significant improvement in the credit cost ratio. The second piece, which is also important to highlight, is to the point that we discussed, that 8% of the loan losses were contributed by just about 1.5% contribution of the captive two-wheeler financing business. That will also become very, very insignificant as we get into next year. That again will provide, I would say, tailwind to the overall credit cost number for the next year. Third piece is we have taken significant provisionings in the MSME business in the current year on account of the issue that we are observing. Hopefully, as we get into next year, God willing, we should definitely see improvement out there as well. That again should provide tailwind to the overall credit cost performance. So my hunch would be that
the gold loan business, the new car financing business are much lower risk business. Yeah. So, and their contribution in the overall balance sheet is growing. So that should also be another element of tailwind to the business.
Yeah. And my hunch would be that while the range currently is 185 to 195 for the current year, and we are inching towards probably the upper end of the range for the current year, the number should be much lower as we get into FY27. And of course, if the first half was 202 and 205 for Q1 and Q2, for even 195, the numbers have to show significant improvement in Q3 and Q4. We believe that itself will provide a massive tailwind to FY27 guidance. But we'll give that guidance sometime in Q4/Q1 of next year.
Yeah. Fine. Just confirming one thing in terms of the MSME guidance of 10 to 12%. You think given the current scenario, the number 10 to 12% is a very conservative guidance, or is a realistic number?
For the current year, right?
Yeah.
Yeah, it's realistic.
Sure. Perfect. That's helpful. Thank you, sir, and all the best for the next quarter. Thank you.
The last point probably, Ashish, on that, as an organization, we have never shied away from cutting business. Wherever we find issue with risk, we are more than happy to take cuts, and that's the power of diversified business model, that we cut a part of the business where we don't find the credit to be acceptable, but at the same time work with other businesses where the credit performance continues to remain very solid, and use those businesses to build the balance sheet.
Right. That's helpful, Sandeep. Thank you.
Thank you. Next question is from line of Priyanshu Ahuja from IIFL Capital. Please go ahead.
Yeah, hi. This is Viral here from IIFL Capital. Thanks for the opportunity. Just two questions from my end. Sandeep, first one for you. On the cost of fund guidance, I see that we have lowered our cost of fund guidance for the full year by around 5 basis points. Does this set up the stage for, say, from here on 5 to 10 bips kind of a margin expansion? in the second
I would love to have that. Viral. But I think the best assumption that we have at this point in time suggests that we will rather hold the NIM at the current level. Idea is to pass on the incremental benefit to customers. We have seen already 27 basis point improvement, and we have passed on the entire benefit to the customers even in the current quarter, and as a result, NIM came in flat versus Q1. Idea would be that work with improving the overall cost of our environment as far as Bajaj Finance is concerned, and use that opportunity to pass on the benefit to the customers and maintain the NIM at current level.
And just as a clarification, Sandeep, in this guidance on cost of fund, you have taken only 100 bips of rate cut, right? Not say any additional incremental that will come in.
Yeah, we are not privy to any further rate cut that is being discussed or has been announced formally or informally. So we have taken only 100 basis point. Having said so, even if there's a rate cut either in December or February, given that it will be too close to the year end, it won't have any material impact on the cost of funds for us as an organization. So you can assume that even with that, the 755 to 760 guardrail probably will remain same only.
Benefit will flow in next year, not in the current year.
Got it, but there will be a benefit then, right? Once that
they will.
Cost of funds,
Of course.
Okay.
Of course.
And second question, Rajiv, for you on the gold loan piece, more so from say a medium-term perspective. I think we have executed there fantastically as to how we have kind of scaled up the book. And I think incrementally a lot of players are possibly looking at how we have been able to achieve this in a market that had long been just say a duopoly or maybe three players at max. Now, fundamentally, how do you see this say over a 2 to 3 year horizon with the entry or the plans that so many other so-called large NBFCs have to get into this segment, assuming say two scenarios, again, gold loan prices say continue going up, or secondly, if they don't go up, then how do you see this basically market evolving as such?
Three scenarios, right? It goes up further, good. Remains flat, good. Goes down. We've seen in COVID it went up to 55,000 per 10 grams and went down to 45. You land up doing fire sale. That's the nature of the business. So adjusted for that scenario, which let's say if I was for a moment leave aside, I would bet that this portfolio could be between, we'll end this year with around, we are at 12,000 crores, we'll end at around 16,000 crores, plus minus. We've just signed up a significant expansion in the business. It should be between 27 to 30,000 crore business by March 27. So we are raring to principally, Siddhant is supportive. Yeah. So we've signed up. We think we're reasonably, and when I say reasonably perfected the model, perfecting the model is not just about aggregating assets. We track leading competitors in this business and the ROEs they generate. We are generating very similar ROEs as they are generating in the business. To us, the metric is not just scale. Metric is the level of profitability, because that was the purpose of building this business. And so we are satisfied with the fact that the business is generating ROEs in line with leading competitors, and thus we can expand. So, and you see structural expansion. You will see from now till March 27, virtually 900 more branches coming through. You would see a set of 500 of our existing branches get converted into gold loan branches, because there is a second order point. As FinAI gets deployed, branches will be rendered surplus, quite honestly. The staffing will become free to do other things rather than doing some of the work that they're doing today. It's a fact. It will happen in the next 15, 18 months, which is connected to the point on FinAI that I was making to you. So two things are coming together. So a cost center will become profit center. Look at it another way. And two, a category which is pretty durable, low risk, adjusted for the third scenario. Adjusted for always the third scenario, it's a commodity business to that extent. We are quite excited about it.
And just on that, even in the second scenario...
Just to come back for a follow-up question, please.
Sure.
It's okay. Sorry, go ahead. And after this, you stop, Viral. Go ahead.
Sure. So just on the second scenario, you mentioned that assuming the gold prices go up or even go down, then in that scenario, how do you think that the market will grow, right? Because
I'll tell you, it's a good point.
Growth is hardly low.
I should have covered that at a fundamental level. See, one of the key modes that we've developed is, apart from generating efficiencies per branch, which technically one has benchmarked and learned, 40-45% of the business is coming from existing customers. Actually coming digitally. 40-45% of the monthly disbursements that we do now, we do 1,700 to 1,800 crores of disbursements a month, are coming from the app. That's really where they're coming from. So it's a moat that we have created, which gives us high degree of confidence in being able to continue to sustain momentum. And mind you, 75 million customers are sitting on the app, 45 odd million are MAU. I don't have branch coverage. So as I multiply the branch coverage, the number will, in general, automatically multiply. So it's a coverage issue rather than a franchise momentum issue or the digital infrastructure issue. So we are at this juncture very comfortable.
Got it. Thank you so much, Rajiv.
Thank you.
Thank you very much. Ladies and gentlemen, we'll take last two questions. Next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Hi. Quickly, if you can help, the softness in other operating income, is it, lower recoveries from return of account, or is it on the lower marketing fees and all? That's one. And in FY27 credit guidance, I understand that, of course, the captive two-wheeler going out and gold and new vehicle increasing. But is there some risk? Now your customer franchise is close to 12 crore. You go further deeper, then each of the business lines where you are, probably you are going to a more of a bit of a slightly at the margin riskier customer. So is that understanding wrong, or will you see some impact from that part because you are going perhaps deeper in each of the product segment? Thanks.
I'll take the first question. The other operating. I didn't hear properly. The other operating income, as you rightly called out, is on account of flattening of the bad debt recovery number. As we have seen, the COVID period write-offs getting cleaned up through recovery process over the last 3 years, the overall bad debt recovery number has started to plateau out. Yeah, and that's why the other operating income has not seen the kind of growth that we have seen in the past. So that has been.
No, but we had also guided that in the current year.
That's overall fee and other income put together.
So that's fee and other income. We have guided to other income.
We have guided for the full year that between the NI and NTI, the entire fee revenue pool that we generate, combination of the fees and charges plus sale on assignments and so on and so forth, all put together, we will see 13 to 15% growth in the current year. I think so far we are holding up to the guidance, and that's how the numbers are speaking about itself. As regard the other operating income, it's mainly on account of flattening of the bad debt recovery number.
The second question was going down the curve. We keep reiterating there is a risk first. That's one part. But the second important part is continue to manage risk at a nuance. As our scale grows, as our complexity grows, so does our understanding improve. So we do not believe that we will grow at the cost of increasing risk. And the franchise is very, very large. We are 13% of number of loans in India on a monthly basis, but we are only 4% of the balances. So we can just continue to pick and choose what we feel comfortable with from a risk standpoint and from a margin standpoint, and continue to grow for a foreseeable period. The gap is actually, it's 4 and 13. It's a 9% gap. That's the share of wallet of the customer that is available that we would like to target over the medium term. It links to the earlier point the gentleman was asking. I think that was Abhijit or that where is the differentiation? Differentiation is in continued mining. The differentiation is between 4 and 13. 4% of balance, 4% market share, 4.5% market share retail, and 13% of customer wallet. So number of loans to AUM, that's the difference, and that's what we'll deliver.
Thanks.
Thanks.
Thank you. Participants, will be the last question from the line of Mahrukh Adajania from Nuvama Wealth. Please go ahead.
Yeah, hi, good evening. Yes. So you transparently laid out all the SME-related issues, and I guess you were the first to flag it off even in the first quarter. But most other lenders don't seem to be flagging any issues. So you would say it's a ticket size issue, or it's something that the sector will eventually have to catch up with?
I have no view on the sector. I'm a bigger believer in micro than macro. I had made the point even earlier that while macro has a role to play given our size and scale and breadth, but risk is a choice that you make, what you want to do and what you don't want to do. So I have no view on others. I have view only on our book. Only thing I can re-emphasize is that we are not seeing it to be a regional issue. We are seeing it as a across-the-board issue. We do MSME lending in 2,000 cities and towns in India, and spans east to west. So, and we are working hard to mitigate that. Is really what I would say.
Okay, got it. Thanks a lot. Thank you very much.
I would just counsel, just as last point, that you guys should take bureau's help in giving you deeper and better understanding of the data. That may be of greater help. So we are seeing pressures on our base definitely.
Sure, perfect. Thank you.
Thank you very much. And now hand the conference over to the management for closing comments.
Oh, nothing. Thank you. Good night. I thought you're referring to Anuj. Thank you so much. Thank you, JP Morgan. Thank you, Anuj.
Yeah, thank you, Rajiv. Thank you, Bajaj Finance team, for the opportunity.
Thank you.
Thank you.
So much.
Thank you very much. On behalf of Bajaj Finance Limited and JP Morgan, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.